Thank you, Ed. Our speaker, Lisa Christian. Everybody, please welcome her.
Thank you. So it's the eve of the eve of the eve of spring break?
Yes,
is that right? Okay. It sounds like a reason to have a beverage at Colorado University. Or cookies. Thank you, Amanda. I'm sorry?
I'm not sure if your microphone is working.
Oh.
Oh, it's on, it's green, and so maybe it's recording. No,
Okay.
Okay, good. Thank you, please.
Okay, great. Yeah, so you guys are the cool kids. Can't you see from the picture? It's fine to see yourself. No, I mean, it might be the Revenge of the Nerds take 2 right now, but clearly, with technology, doing so many great things in our society, it really is the cool kids who have been doing a lot of inventing and making this world a better, more connected place. But I'll give you even more reasons to think you guys are the cool kids during the course of this presentation, I hope. And how do I advance? I got to make sure I advance this properly. I'm not sure what I did. I apologize. Do you know, is it this one?
I think it's,
No?
if you come back, it's the one next to it. It's the little, the next one to the, in between, that one.
It didn't go. All right. There must be.
Perhaps it is high presenter. Are we in presenter view? There we go.
There we go. Okay. All right. So it sounds like everybody has it memorized, but what we're studying here is the intersection of technology, cybersecurity, and policy. And financial technology, or FinTech, takes that world and looks at it from a financial services perspective. Could you just let me get a sense of who we have in the room? Does everyone here know what FinTech is? If you do, would you raise your hand? Okay, so really only a couple people. So if you use maybe Zelle or Venmo to exchange money with your peers, you're using what's considered a FinTech company's products and services. So there's been a lot of innovation in financial services, especially in the past decade, bringing these types of things to our world. If you happen to be, say under the age of 30 or a millennial, you may think these things are just the way it's always been, but it actually is pretty new in terms of invention. And my other question is, if you are a millennial, will you please raise your hand? So are most people kind of under 30? Raise your hand. Yeah, okay, that's. See, to me, you're like all alike because I'm kind of like way up there. Okay, so here we go. Financial services. So since you guys don't know about FinTech, you might not know too much about financial services. So we're going to spend some time on that today. And one of the reasons we want to do this is for any industry that you might be interested in working in as someone who's a network engineer or has a very technical focus, still knowing that business can pay dividends in your career for years to come. So you might just think, I'm just going to be behind the scenes doing X, Y, Z, but if you actually take the time to understand how your industry works, you can elevate yourself to higher levels of leadership if that's something that you desire, and you can help think about ways to improve your operations, do better things for your customers, and just make your business more valuable, which makes you more valuable as a professional. So some common things to understand about the financial world, the difference between financial markets and the economic system. So some people think the stock market and the economy are the same thing. They're actually not. We have an economic system that's much broader, and the stock market is a subset of that. So the stock market is not necessarily reflective of everything going on in the economy. the financial markets themselves reflect the supply and demand of trading securities, commodities, other goods, stocks and bonds, things like that. And more broadly, the financial industry is a facilitating function. So it will help all businesses, all governments, all consumers to exchange these goods and services by creating this financial infrastructure. So it touches all of our lives. And as consumers, it's important to understand, but again, if this industry interests you as a place to work, truly understanding it will make you better prepared for the road ahead. So a little more on the financial system. This is a diagram of what I call the critical banking system. The banking system is truly important in our society. And as I mentioned, it'll serve consumers all the way down to big businesses, governments, nonprofits, and everything in between, such as small businesses and middle market companies. There are a couple different types of banks in the system. One are commercial banks. Those are your typical bank when you go into a branch for, say, a checking account or a loan, so that their primary activities are lending and deposits. Investment banks that get more into the capital markets, such as mergers and acquisitions. And then there are other financial intermediaries, such as insurance companies and what's known as shadow banking. So that's kind of all the banking that's not within that regulatory system. And fintechs actually fit into that if they're not regulated banks. There's actually $34 trillion working through the system in shadow banking today. So even that is huge. The overall system is more like in the quadrillions, which I texted my dad, and because I knew I was going to say that, and I'm like, I don't know how many zeros is in quadrillion. I'll check my phone and see if he got back to me. So there are also a host of products and services, if you will, that are offered by banks and financial institutions. And as a consumer, you may not think of my checking account as a product or service, but for the companies that are actually offering these services, that's exactly how we just talk about them. So deposits, lending, mortgages, wealth management, equities, meaning stocks, payments, so exchanging funds between consumers, paying your bills online, things like that. Mobile payments, so actually maybe using your phone instead of a credit card to make a payment. Capital markets, which is the activity of stocks and bonds, currency exchange, and on down the line. There's just a litany of services that the financial institutions offer that fintechs have started to try with the technology focus to disrupt and change and make better. So financial firms and fintechs are both the fintech industry, meaning large financial firms that are very innovative, that are always working on new technology and innovative ideas. They're in that fintech space, as well as these more startups and many have grown up who are really disrupting the industry. But they're kind of considered separate. Some are incumbents, highly regulated banks. Others are newcomers that aren't necessarily having, at least in the beginning, to be so focused on regulation. They're just trying to get off the ground and see what we can do to make this system a better place. Also, these financial services firms, they facilitate the financing of the fintech industry and everything else. So when we have this one class on fintech at the university, and it is crazy trying to teach it because we have 16 weeks and all these products and services, all these different customer groups. And then you think about, we're offering stuff, but we're also the companies themselves. So we need funding, right? So you have to start to think about, how does a fintech firm get funding? How does a big financial firm get funding or then provide funding? Who else does it? So there's a whole lot to the industry, but I just wanted to point out that financial firms and fintechs, they're the product, but they're also funding the product, if you will. And financial firms play a key role in a couple concepts I'll talk about later in more detail, but information asymmetries risk of adverse selection, and moral hazard. And these important things, if you will, that financial firms have to do are the underlying reasons why we have regulation. And so this is an area where those who are successful in the financial industry really need to command this knowledge of compliance, and they do very well for themselves, so that's why they get to be cool kids. Okay. And then just one very important thing to point out is that lending, more so than bonds or stocks, it's the main source of funding for businesses in the United States and even more importantly in other countries. And we're going to talk about some of the challenges the financial industry has had, which led to the great financial crisis 10 years ago. Does everyone know about the global financial crisis? Yeah? Okay. So this notion of lending, and we'll talk about kind of how we got there, is very important because it was lending business that really pushed us into that crisis with all these other factors in play. And so as we think about the role these fintechs are playing in our society with all these tech startups, there's a lot of question about, is there a bubble? Could another bubble burst? What would it mean, et cetera? And one of the big indicators of the kind of trouble we can get ourselves into is what's really going on in the lending world. Okay, so there's another bank, the biggest bank, the central bank. It's the bank for banks. That is important to understand when you work in the financial industry. And this is an entity called the Federal Reserve System in the United States, the Fed. So the Fed, if you read the Wall Street Journal, is mentioned a lot, mostly in the context of Jerome Powell, who is the chair of the Fed, and what are we going to do about interest rates? Because every time there's a slight tick one way or the other in interest rates, everything from our mortgages to the value of our stocks and bonds is affected. So the Fed plays a very big role in stabilizing our economy and putting liquidity in the economy, many different things, acting as lender of last resort, providing banking services to the U.S. government, issuing currency. So there's a host of things that the Fed does to stabilize the economy, and that's why these Fed chairs and governors are, critical to our well-being. There's other important central banks around the globe, like the European Central Bank, Bank of Japan, People's Bank of China. Actually, interestingly enough, reorganized in 1995 to be more like the Fed. So as you look at, say, Chinese monetary policy and how China has adopted things like, inflation targeting, printing money, if you will, they're actually mimicking the United States, which is not a bad strategy, to be honest. So historically, we've had these big financial institutions like Barclays, JPMorgan, Citibank, and they have long been innovators, even though they kind of now have been more accused of being these slow, big incumbents, or at least over the past decade. Things like ATMs, adjustable rate mortgages, credit cards, futures, options, derivatives, asset securitization. These are all things that big banks have done in their histories to continue to innovate. And it wasn't until about 10 years ago that this whole FinTech revolution started, which coincided with, the aftermath of the big financial crisis, and kind of made the banks, be a little bit more under the microscope, if you will, in terms of what are they really doing to innovate and protect consumers. But there are just litany of inventions that have come out of the financial industry over the years. And so they have responded with, trying to be just as innovative as the fintechs. Maybe they have bought some, maybe they buy from them, or maybe they've developed in-house, but they have really responded. And so these big institutions do have an advantage in the sense that there is an established customer base there. Millions of people are customers of these big banks. Some people trust them, particularly older generations. They already have revenue. They have access to hordes of capital, and they already are masters of regulatory compliance. Even though you may read in the news from time to time that somebody has broken a law, but by and large, these organizations are very capable of handling regulatory compliance. And then you take, a startup company and try to build a customer base and get some revenue and attract your capital and comply with all these regulations, and it's very difficult. So they have that advantage. Banks, though, have a storied history, as does our economy, of booms, busts, panics, and crises. And this only takes us back to 1907. There's like a whole history, even preceding all that just goes to show that whether it be a scandal, whether it be, economic circumstances, this industry has seen a whole lot of drama in history. And, going back to the Great Depression, the big bank panic of 1907, the S&L scandal in 86. So I started working on bullet number 4, basically, right after that. So I've kind of lived through a lot of these. And, they do create a lot of uncertainty in when you're working for financial institutions like that, but also, in the U.S. as well as around the globe. And we've noticed that the U.S. has, started a lot of this, like say the global financial crisis, that was the U.S., a U.S. problem that spread to the entire world, and which also goes to show how important this industry is, because we want it to be healthy so that we don't get ourselves into those kinds of problems. And so because of all these, panics and whatnot, banks can tend to get a bad reputation as being, the causes, right? Well, who caused that crash on Wall Street in 1987? I was a freshman in college, and all of my friends were like, oh my gosh, we now have no money to send me to college. And I was like, oh my gosh, we never had any money to send me to college. So we don't care. So, but it's just, very interesting to see this whole thing. And so then, like say the tech bubble, and everyone wants to blame someone because, so I started saving money right around the Mexican crisis. Well, then when, the tech bubble happens, 20% of my money's gone. You don't blame people for getting mad, right? And then global financial crisis was worse. So not everyone has a crystal ball to see all this stuff coming. So banks get, a bad rap for being crooks sometimes. And we always worry from an economic perspective. You can come in. Elsa, hi. I don't know if there's any open chairs, though. Are there? I think there was one sitting out in the hall. So when you're kind of, where we are now on this end of a really nice bull run, we've had a really great run, right, in our economy. We've been predicting a crash for a while. We were predicting interest rates were going to go through the roof for a long time. So nobody really knows, but we want to know kind of how to prepare and to think about it. So, one of the things to do is just think about, well, what does it mean to be in a bubble? And it's really when we're seeing this rapid escalation in asset prices over what their perceived value is. And there's all kinds of little tests you can do to see if we're in a bubble, but kind of, rule of thumb is if there is absolutely no revenue and your company is worth billions of dollars, we may be a little overzealous. And if we're the overzealous ones, we're the bulls, because we want to support the market going up and we want the buying frenzy to take place. So even though we don't have any revenue, we want more people, putting their money in my company so that the valuation goes up and my value of that stock goes up as the owner. So we're the bulls. We want the market to go up. The bears are the ones betting for the market to go down. So these poor souls are the ones who've been saying for forever that interest rates are going to be 20%, by the time we are where we are today. They weren't right, but they want the market to go down because they placed their bets accordingly. So, there's always this tug and pull of what's going on in the economy and where we are, and nobody wants a boom, bust, panic, or crisis. Especially like the global financial crisis, because that really stunk. So just a little context, so what was behind that? And then you can think about, what's going on now, to think about, are we setting ourselves up for another one of these? So it really started with home prices, even dating back to the 80s, home prices going up, and they really escalated in the 90s to about 2006. So here, all of us homeowners thought we were just geniuses. We're owning these, great houses we didn't pay that much for. And mortgage brokers, started to proliferate across the U.S. So everybody is like selling a new mortgage, refinance with us. We've got lower interest rates, et cetera, et cetera. And that's going on all over the country. Did anybody see The Big Short? Yeah, great movie. Totally go see it. It explains this all. So that's what's going on in the country. Meanwhile, on Wall Street, we have these, financial geniuses engineering derivatives, specifically mortgage-backed securities, credit default swaps, and collateralized debt obligations that basically kind of started to erupt and become weapons of mass destruction for our economy. But so there's this, everything's going on in the country where everybody who shouldn't get a mortgage is getting 4 mortgages. And then meanwhile in Wall Street, we're creating financial instruments to take the risk around this reality and just keep shoving it off to the next guy. And so what happened was then a bubble happened in the housing market. So we had subprime loans, for example, being made to people who unfortunately maybe didn't have a job or any cash flow, who couldn't really pay these back. Once, say, an adjustable rate mortgage that had a super low rate went to a high rate, they would not be able to cover the mortgage payment when it went up. So when the housing bubble, the price of those homes went down. Meanwhile, they were underwater because maybe they owed $100,000 and the home used to be $120,000 in value. It's down to $90,000. So they're underwater. They can't even sell that house to pay back their mortgage. Then suddenly their interest rate goes up, so their mortgage payment goes up. They can't pay that bill, so they're going to default on that mortgage. And we just sent thousands of people into foreclosure that lost their homes as a result of this. And when that started to happen, this passing of risk that went from I originated a loan, and then we went through something called securitization, where if everybody in this class had an independent loan from a bank, we could divide you and say 2. You guys are high risk, you guys are low risk. Okay, we're going to put you all in a bundle, and we're going to put you all in a bundle, and we're going to sell you off to another bank that would buy these as 2 separate securities, if you will. And then when you guys are paying everything back, that's how those investors get paid. But it's in like a productized thing where you're bundled, so risk is supposed to be diversified. But when everybody starts, dropping off and being unable to pay, those assets that these banks then owned became not valuable. And so they started to find themselves becoming insolvent. And then they had liquidity issues as well. So there's just all these things were going on. And next thing you know, we start to see these massive losses in equity markets. The Dow Jones Industrial Average dropped 54%. Housing collapsed. People are evicted. The economy went into a recession. We spread this contagion to Europe. And these mortgage-backed securities, especially those containing subprime mortgages, were a significant contributing factor to that. And by the way, we still have mortgage-backed securities. This is what put, say, Lehman Brothers into bankruptcy and ultimately out of business. We're spreading that risk around a little bit better. We're requiring more capital reserves be held by these banks so that there is more liquidity in the system. Back then, when they were doing all these, fancy derivatives and whatnot, these banks were actually not holding much capital. They were just basically expecting everyone would be able to repay. But when they stopped repaying, the cash flow stopped, and then they didn't have enough money to cover even their own obligations. So we've made a few moves to be able to require banks to increase their capital reserves. So if you see in the Wall Street Journal, regulation's bad, we should get rid of these capital reserves, we should think twice about how we did this in the past. And maybe there's a happy medium there. Maybe we went overboard, with banks a little, but we definitely want to be cautious about these types of big decisions because they can affect the economy. And we even have ETFs now with mortgage-backed securities in them, so consumers are participating. So the world has changed a little bit, but this crisis definitely was a big one. So the financial industry in general has long been a pillar in our global society, but they've also been sharks. Because this was kind of a shark thing, okay, the Lehman Brothers thing. I mean, the CEO actually said, everybody in the world hates me, but my mom still loves me. I mean, that's just kind of a sad statement, right? But people were making a fortune, on all this crazy financing, and it blew up. And people who, lost 54% on their investments in the Dow Jones Industrial Average, that's their retirement savings, right? I mean, this might be an old person who, what are they supposed to do? Go work at Walmart now? I mean, it's pretty sad what happened. So for this reason, banks kind of got a bad reputation. And fintechs came to be. And as I mentioned, this has really created a loss of consumer confidence in banks, and this global financial crisis was a catalyst for fintech development. So I hope we've helped you understand the gravity of this. You guys clearly have either studied it or lived it, so you know too. But because of then the reputation that banks had, especially with younger people, these fintechs started to pop up, which is pretty exciting because it's all more technology driven than say human driven, right? And then thankfully robots would never do anything bad, or AI could never turn evil, so the world would be good, right? Not exactly true. But where we are now is that this notion of using technology to make humans smarter, that's where we are. So we've kind of had, in the big banking world, certain things, happen in the sense that a lot of people don't consider fair. Like, okay, a lot of money in the United States is concentrated in the hands of men over 50. That's actually 75% of the money in America is in the hands of men over 50. So if you're not in that group, you'd like some money too, right? So, yeah, exactly. So anyway, there's this kind of, inequities that it would exist. And then, how these, say, relationships where you could borrow as a small business owner, might have that same sort of flavor to it in terms of kind of who gets and who doesn't. And technology can actually improve that. And that's what we've seen happen with these fintechs is they've come on, and with all of these great apps, the fact that we have smartphones, the fact that we have young people wanting to give all this a try, we're offering loans, wealth management services, things that used to be the purview of maybe the wealthy or select groups to anybody now. So I like that. That's cool. Yeah.
So is that a global phenomenon or only localized to the States?
It is a global phenomenon. And it's actually even hotter right now in places like Southeast Asia than the United States, in part because of regulation. Again, why regulation can make cool kids. Because, if the U.S. is getting a little too tight on some of this, we're actually going to leave ourselves short in some ways too. So we have to kind of balance it. But literally, fintechs have really democratized financial services, and that is something that we can all be very excited about. Now, because they've been able to kind of grow with this lighter regulatory touch, they could actually become a problem if they become big enough, though, because they could become systemically important, such as a firm like Lehman Brothers. And if things go south and we haven't properly regulated them, those participating in that system, you could lose out, because if you're putting money in a fintech that doesn't, say, have FDIC insurance, then that fintech goes under, your money there is not insured, and the U.S. government isn't going to help you get your money back. So we have to be super careful about that. And there's that in America, but that's all over the globe. And in places like Africa in particular, where there just aren't a lot of banks, fintechs have gone in and actually created so much opportunity for commerce through these fintech applications. The word of caution, though, is you want to make sure you're not dealing with a shyster, right, who's going to take your money. So because there are even fewer regulations, to protect those consumers. But interestingly, too, if you follow kind of, what's going on in technology, which I'm sure you all do, this gap between sci-fi, that which was once imagined, and sci-fact, which is becoming real, that's shrinking. So that's pretty exciting. So since I sounded a little negative, I wanted to put a sunshine with roses slide here. Because technology has evolved and has transformed our lives and society for the good in so many ways. So, just taking a pause and quitting worrying about regulations and causing panics and bubbles, we're making banking convenient. It used to be you had to go into a bank, right? I mean, you guys are probably like, who goes to the ATM anymore, right? I mean, I don't even carry cash myself anymore. So there's so many things that they're making our lives so much more convenient, faster. Communication is incredible. We can chat with people all over the world. Things are more accurate. I mean, people make a lot of mistakes, more than computers. So we've got all these things going on that just make the world a better place, including development in things like the medical field and truly game-changing, let's clean up the environment with XYZ technology. There's so much that we have to be really appreciative of technology. And sunshine and roses. So fintechs have, come into the scene and have really done a ton innovating. There's a lot of technologies I know you guys are studying in other classes, that touch into this world, but and so some of it, has obviously kind of paralleled the fintech hype. And we were probably at a peak at around 2015 of, all this fintech's going to, get rid of the big banks and whatever. So we've kind of come down from that, but we do know that they will be a disruptive force in finance. And the big promise of these companies is that consumers will get more choice, will get better targeted offerings and pricing. So because of technology's ability to profile us, we can get what we really need. Small and medium-sized businesses can get access to credit, which there are tons of companies, bless you, that have popped up that make it super easy for a small and mid-sized company to just go quickly get an unsecured line of credit. Whereas in the past, you would literally, as that small business owner, have to write a business plan, sit down with a banker who would look at your business plan. Then they would take all of your stuff to a credit committee to get that approved. There was just quite a process involved. Now it's just more, easy to get it overnight. Banks are more productive as a result. The financial system itself is more resilient. And fundamentally, and this is what I love about it, is that it makes financial services a more inclusive place with all of us being better connected, more informed, more empowered as consumers. And it's kind of cool that so many millennials and everybody under 30 is really engaged in financial technology, because that's going to make us smarter when it comes to saving and planning for our own futures. So there's a lot of really good things that came out of this. However, you have a question?
And so the thing that you said earlier was regulation. And so there are regulations to protect some of us younger people and also some of us older people.
Yeah, I mean, there are, but I will tell you that not all fintechs are chartered banks, okay? So if you're not a bank and you're just a technology company, you're not under the same set of rules that a bank is. So you got to be kind of careful with that. And frankly, because older people tend to use the more staid, they're a little more protected. And so for fintechs, they've had to overcome huge barriers to get bank charters because it's such a highly regulated industry. And for a company that's a startup to comply with all the regulations that they need to, the cost estimates on that range from like $1 million to $30 million. And some of these guys don't even have $1 million, let alone 30 million, right? So they've been able to, with the help of regulators, have fewer requirements so they can get off the ground, because people have wanted to see this kind of innovation, particularly after the financial crisis. but for them to grow, they do need to do more. So when I think of fintechs, I think of baby sea turtles. Like they hatch, right, on the shore somewhere. These little turtles come to be, and they got to go somewhere. So it's, a nice little existence at first, but they then need to start getting funding. And so about every 1 in 1,000 pitches actually gets funded. So it's really tough to get one of these businesses off the ground. And even when they've reached some level of viability, it is truly survival of the fittest. They have to figure out how can, they make it through this much more competitive ocean with those sharks competing against them. Because when fintechs come out and offer something, cheaper and better, a bank with millions of dollars just sitting there waiting to invest can come out and squash that guy, right? So competition, regulation that I mentioned. So as these fintechs grow and they start to look like banks, that's when regulators will come in and expect them to, mature the way they're mostly protecting the consumer. So these regulations are really there primarily for consumer protection, but also for the protection of our economies. So if there is, a company that's appearing to have, say, some shady practices with how they're managing your data, how they're soliciting you, profiling you, whatever, that's when regulators are starting to take notice when they reach a certain size. And even fintechs, when they start to develop, there's new technology always around the corner. I mean, there's a lot of really cool stuff going on in blockchain right now that seems to be, gaining momentum. If that jumps ahead of, some of the more traditional development processes, even fintechs can start to be behind. Getting customers is a big deal. This whole, do I trust this company that's brand new with my hard-earned money? Geographic distribution. So this is a big regulatory challenge that we're starting to move past, where fintechs could actually start to get a bank charter and legitimately be in business. But because of the way the U.S. has not had laws at the federal level, they have to go state by state in order to expand and get approved in Colorado, in California, in New York. And that's where the $1 to $30 million has come into play. Now, this past summer, the OCC, the Office of the Comptroller of the Currency, that's part of the U.S. Treasury Department, did allow some provisional fintech charters at the national level, so that's a giant step in the right direction. But they excluded deposit taking, so they limited it to lenders and payments companies, but didn't want to put the FDIC in the spot to have to insure these investments. So again, a lot of movement, right? Price pressure, that's another thing where even with these big banks, you probably feel like banking should be free, right? They're holding on to your money. Well, it didn't always used to be like that. Like we used to have to pay for stuff in the old days, and banks made money that way. And then as prices have come down, ETFs are free. Go into the ATM, it's free. All this stuff is free. They've got to figure out other ways to make money. And so for fintechs, if they come out with one product and it's free, that's really hard, right? And we've seen prices come down over the past 10 years since these fintechs have started to come, into our society. And so that pricing pressure is not only affecting big banks, they're driving a lot of it, but that can drive a small company out of business. Funding, where can they get the capital to get this business going? Economic forces, interest rates, things going on in the economy can be tougher for a small business to weather. Cybersecurity, very big issue, as you guys know. And then just reputation and brand. How do I create a brand? How do I do all this marketing so people know me and trust me because I haven't been around? And people in the older generations definitely prefer the household names. So we have, though, seen quite a bit of growth, and to Jim's point, all over the globe in fintechs. So now there's 39 companies valued at nearly $150 billion that have popped up all over the world, focused on financial innovation. And as students, does anyone have an interest in the financial industry, like getting into it? I'm curious. Maybe not, right? Yeah, because, well, unless you're super financially motivated, it might not be intuitive, right? But because there's all these other things that you could do, like save the whales with technology, or something that maybe would feel better in a sense. Yeah.
But every fintech is probably using some computer network. It wants it to be secure. They need professionals to manage those networks.
Exactly.
So trust me, all the people in this room are interested.
Well, you are, and I was going to say too, but even if your passions are somewhere else, say it's healthcare. Healthcare cannot accept a payment from you as a patient without financial services. I mean, it's literally underlying everything we do. And what's also nice about it is they pay their bills, which includes our paychecks and all kinds of good things. And what we need in our world, in my view, is people who are going to go into any industry, no matter what some excluded, okay, but no matter what anybody has to say about it. People might say, oh, these financial firms, they're sharks. Well, if we have more good people, like the people in this room working in them, then that improves the industry. So good people are needed in every single industry, and this one is a critical one for society. And being able to, in Africa, for example, allow people to borrow money. They have some of the most successful microloan programs in Africa facilitated by fintechs, helping a woman who wants to farm coffee, export to the United States. That is enabled by fintechs. So even if it might seem like not a direct benefit to society in your mind, first of all, keeping the system strong clearly is important, because we saw what happened when the system wasn't strong, right? Really bad things. So the more good people we have keeping it strong, the better. And more people who can recognize the positives of an industry like this and what it can do to everything else in the world, I mean, the better. And for your own sake, just having a good job that, is secure is not a bad thing either. Just saying. So fintechs, very much like banks, cover all these same types of services to the same groups: consumers, small to medium organizations, large enterprises, ranging anywhere from lending to banking, securities, et cetera. And because it's so broad, I just picked a couple to kind of focus in on, particularly because I understand you guys, like there's a lot of blockchain folks in the room and ICO, crypto people.
Don't glass.
Cool. So one of the great inventions of fintechs has been robo-advice. So these three companies, Vanguard, which is actually a more established firm, Betterment, and then SigFig, the last two have been fintechs that have popped up in the past 10 years or so. These robo-advisors have done an amazing job with performance. Now, they've only been around for a couple years. They have a 2-year track record, those on this list. And they have been able to, well, some have longer, but the ones that kind of people feel are viable are ones that have been around at least for a couple years. Because if you just pop up and you don't have a track record, it's hard to say, yeah, this robo-advisor knows what it's doing. So this is all technology-driven, portfolio allocations, and keeping, a certain amount of your money in stocks, bonds, et cetera, and then having that all automated, where in the past, it was done by humans. So some guy who worked for Wells Fargo that we were paying like $500,000 a year to, this big portfolio guy is suddenly getting, his lunch handed to him by a robo-advisor, which you can get for hardly anything. So it's very interesting. Again, this democratization of financial services that's been enabled by technology is very much seen in these robo-advisors. Well, the human intervention piece, is that what you're asking about? It's pretty much, we program the computers to do what they need to do, right? So yeah, it's kind of apples to apples in terms of, comparisons. Now with the robo-advisors, it's been kind of interesting because this has only been during a bull market. So this includes, say, passive investing, a lot of ETFs, where everyone's going to do well in a bull market. The question is, when you see a bear market hit, do we want that $500,000 guy from Wells Fargo? We don't know if we really need him yet, so I guess we'll find out. But when it comes to lending, like I was saying, to go online and auto decision something like a small business loan of $10,000 that used to take an army of people, that's just a no-brainer, right? Here's another one that I think is super cool and relatively new. So this company called EquBot, they are using proprietary artificial intelligence with IBM's Watson computer to be the Wells Fargo guy, the $500,000 Wells Fargo guy. So robo-advisors are, look at the big portfolio. That's how you're going to allocate your assets. And they're not, and again, when you're investing in, say, ETFs and kind of more passive things in a bull market, it's a little easier. I'm not saying it's super easy, but this ETF is actually one that is mimicking the more active manager. So it's looking for, say, market inefficiencies and things that, usually humans have only done to this point. So this is kind of interesting to see. And this is from my trading mentor. We're on the way up. So things are looking good right now. We dipped down because the whole world, frankly, dipped down for several months in the market. And they also have one for international. And so what's cool about this one, again, they saw a dip, just like everybody else, but this is an international fund that is actually on par with the S&P 500. And because, the U.S. markets have been doing better in the most recent, say, year or so, that's a big deal because they got international markets to perform as well as the S&P. So I would say Watson's smarter than the guy at Wells Fargo. No offense to Wells Fargo.
Is that Watson, one that played chess?
Yeah, Yeah, he's not a real person. So here's another one that's pretty cool. This is JPMorgan, which just announced a couple weeks ago, crypto for currency exchange. So JPMorgan announced a new coin, JPMCoin, and this is enabling companies in the network, which includes a lot of very big companies globally, as well as a bunch of different big banks, to do what they used to do for a whole lot cheaper. And what they used to do was, for all this global trade, you would have to say, because I have operations in Ireland, keep a certain amount of money on reserve to protect yourself against, say, currency fluctuations and the risk that, they're not going to go in your favor, basically. But with this coin, they have actually eliminated this risk by allowing people to say I'm a business. I can trade my US dollar, which is pegged to the JP Morgan coin, for a coin. Then that coin can actually get converted to, say, euros or whatever it is, but in that market, and then I avoid having to, retain all that currency risk because I've automatically made that conversion. And so companies are just finding they don't need as much cash. They're paying lower fees, and they're not incurring the actual exchange rate risk. And if you operate a company, say in Europe, you will know if currency doesn't work in your favor, every quarter you can have a positive, or you could have a negative effect on your earnings, and that's a big deal for even the value of these companies. So these types of solutions are extremely valuable to businesses in many, many ways. So that's a little on financial services. And I wanted to touch on the consumer because the consumer is super important in this equation. Consumers, for many, many inventions, might not have caught up to technology. And so things like artificial intelligence, we've had this for as long as I've known, 20 years that I've been working in the field, and it was here before me. But until consumers like millennials are willing to interact this way with a bank using artificial intelligence, the technology didn't matter if people don't want it, right? So we are seeing this explosive growth in innovation because of the millennial generation and those younger people who are highly, likely to do a lot of things through an app, use mobile phones, tend to be more educated. They have more negative attitudes towards big financial institutions, so we'll take a risk on a fintech. And because they actually are the people who work for a lot of these fintechs, people enjoy the startup lifestyle. A lifestyle that was not available to me when I was 20. They had to suffer in a suit for 12 hours without food or water. Just kidding.
Uphill both ways.
Uphill both ways. We chopped wood, burned it. No, just kidding. These consumers today now believe technology can help us better manage our financial lives and reach our goals. And so because people are using these services, it's really cool that we're starting to see our goals are linked to our financial goals, even though nobody here wants to work in a bank. And consumers are saying, hey, the invention that seems to be the most interesting to me are these robo-advisors. People can see themselves using them. There's all kinds of other technology that consumers believe will have a big impact on financial services, including robos, cryptocurrency, Bitcoin, AI, big data, robotics, virtual reality, blockchain, augmented reality. And then what they think they're going to be using are robos, robotics, AI, down the line, but they don't see themselves maybe using cryptocurrency or Bitcoin or blockchain. But stuff may be going on behind the scenes. They don't know they're using it, but they're using it, right? But what they see and what they're going to demand are robo-advisors. And another thing that came out of consumer research, this was done by Charles Schwab, that the need for both humans and technology is there. And these fintech business models are maturing, and the ones that have been established players that are called incumbents, they've been innovating and they're thriving. So, with this human and technology marriage, that's where companies really are going to be winning the consumer over. All right, so a little on tech. We're running out of time, so I'm going to go fast. So the big five. Mobile, cloud, AI, open source, and blockchain are the big ones affecting the financial industry. Yeah.
Okay, all of those are deeply, these are relevant to network
Okay.
engineers.
Cool. I mentioned this mobile application in Africa. Mobile, if you look at the CEO of Microsoft, you'll say, what are the big drivers of your strategy? And it's mobile cloud. That's it, right? Mobile is just so big for all of us. And, no better place to see it than Africa. And I already kind of told that story, so I'll skip it. The cloud, huge because it's making everything cheaper, more open in these, networking facilities. It's lowering the expenses, capital expenses, operating costs for companies, giving us speed and agility. For the companies offering the services, they can have, the Ciscos of the world, they'll have the economies of scale and scope to actually offer them. And then if you're an entrepreneur, you can just plug in and not have invested like in the past you had to. So the cloud is key, obviously, both for how companies are using technology, but also then how cybersecurity, right, is shifting to protect it. Artificial intelligence. We talked about the purpose of AI be to empower humans, not replace them, and put the two together and we can outperform either alone. In financial services, we see that in marketing, how you're getting all these emails or predictive suggestions to purchase things. A big area where it's improved is in credit analysis, to your question. When I first started in banking, we actually had to, manually go and look at someone's financials, their tax returns, and say company financial statements, and decide if they're creditworthy by cranking out some, literally manual analysis. We would innovate that as much as we could, but until you had things like a FICO score, or even ways now we're even going beyond the FICO score, it becomes really challenging. So we have seen artificial intelligence be incredibly helpful there. Same with retirement planning, helping people plan for the future with how much do I need to save, how should I allocate my portfolio, et cetera, et cetera. In capital markets, same kind of thing. So this is more, trading and, derivatives, stocks and bonds, et cetera. So a lot of this is very back office. Those old manual processes, like, does anyone know what a trading pit is? Yeah. So like, we don't really have those anymore. But in the old days, not too old, long ago, people would have to like write up manual tickets. It was open outcry. I want pigs and I want hogs or whatever. They'd write it on a ticket and it'd be a giant mess, and whatever's laying on the floor, who knows if they missed a trade. We don't have those problems anymore because in the 90s, they worked on it. But now we're taking it to a whole new level and making these automated systems even more automated. Open source software is another one. So this is also consistent with the kind of a millennial vision that we have a more open society. So in the financial industry, we have a really interesting consortium called R3, which has an open source solution for blockchain, and the platform's called Corda. And a lot of companies in that industry are operating on that system. And because they're building that one system, so many companies can go in and use that platform and innovate. Definitely, companies like Google and Microsoft are doing the same for other industries. Blockchain, as I just mentioned, R3, very big deal in financial services. And one of the most interesting applications has been the derivatives trade clearinghouse, DTCC. So this is how large dealer banks clear their trades. They are literally using blockchain now, and in the fall of last year, determined that distributed ledger technology can support their trading volumes. So anybody who has ever had concerns, which obviously we did at the beginning, that blockchain couldn't handle scale, needs to understand that they actually process like quadrillions of dollars. Like I said, I don't know how many zeros are in that, but we can handle the volume, right? And in physical commodities, same kind of thing. So this example here is how blockchain and financial services actually can provide and has provided now new solutions for somebody shipping oil from one country to another. And in the past, there was property, changing, ownership changing hands multiple times. There's actually the, need to actually inspect these things. People actually have to get involved in so many different steps in this process. And using blockchain, we removed a ton of these steps and made them so much more efficient to the tune of what used to take a bank 3 hours, now is 25 minutes. And I don't know if that seems like a lot of improvement to you, but it's, say, 6-fold. And to a bank, that's a huge deal because that could be something that, it's like 3 hours of a banker's time could be $300. And then if now that's suddenly $75 or something like that, you basically multiply that by countless transactions and you're saving a ton of money. So the efficiencies to the bank can then be passed on to the customer, and then traders and others become more efficient there. There are some hurdles with these implementations in the sense that people are maybe not so comfortable, especially in other countries that don't have blockchain ready to participate, but we're on the way. It's pretty cool. And I was just going to say there's a FinTech ETF that's up almost 22% year to date. So this is another one where we can kind of keep an eye on the bubble. We're not in a bubble, we're in the green, so we're good for now. But we got to keep an eye on it. And as we were all struggling with the stock market earlier in the year and around Christmas time especially, that's where people started to get a little bit nervous, but somehow we have pulled out again. The bull market lives. All right, so policy, real fast. Regulations have, starting to become an issue for startups. As I mentioned, they've been given a hall pass early on, and now these fintech firms are upping their focus on regulatory compliance. We have to think about things like anti-money laundering, knowing who your customers are.
Anti-money
Laundering. So, because you guys are familiar with, the shady side of the dark web and cryptocurrencies and whatnot. I mean, that element is really not who we want in the banking system, right? So that banks would have vetted out a lot of, those players in those systems, basically. And in the US, this is just a nightmare to even think about, but here's this smattering of regulatory bodies that fintechs would had to work with. And we're actually at CU getting together with the SEC in a couple months to start to partner and share information back and forth with how the regulators can actually be fostering more innovation in a responsible way. So this is pretty exciting. And they do have good underlying motivations, such as avoiding, these kind of bad actor customers. That's the notion of information asymmetry. If you don't know who's on the other side of the table, banks do a really good job of figuring that out, and fintechs can't do that. Moral hazard would be that you've got, one party passing on excessive risk to another, and we saw that in the financial crisis. We're on top of that. Not a lot of this is touching fintechs, though. They're not kind of significant enough for it to be a factor. There are issues, though, and regulators are keeping an eye on things like cryptocurrencies, lenders in the marketplace, et cetera. So we want to encourage innovation. We just want to do it without providing criminals with tools for fraud, money laundering, terrorist financing, et cetera. And regulators came in and helped us out in the global financial crisis. It's why things are pretty tight. As you mentioned, anti-money laundering has been a big focus. And at the national level, organizations like the SEC and FINRA are the ones we really look to keep us honest. And they're chipping away at things like crypto. Bitcoin, I see, is getting taken off the Chicago Board of Trade. They're not going to trade futures, I guess. So, companies have to really stay, worthy of being listed on these various exchanges. But we are chipping away at some of the things that have held us back. And a big market has emerged to help with compliance. And I am going to skip that and just say one thing to you guys, and that is CEO math. So I'm going to close out because I could talk all day. I have a whole bunch of other slides. I put them in a category called deleted scenes in case we had time, and I should have known that we wouldn't. But I just want to share this one notion with you. It's called CEO math. And so when you are a professional and you're in cybersecurity, what you need to understand is that, for you to continue to get people to want to invest in cybersecurity and keep pushing it forward, that whom you're trying to sell this to has other competing priorities. So for every dollar, or for every $100 in revenue, not even 10% goes to IT in general. And of the IT budget, not even 10% goes to cybersecurity. So if you're trying to tell a CEO, make me a priority, he's like, you're $1. I got 99 other dollars to think about. So help me understand why this is important. And I just wanted to convey the importance of honing your skills as a communicator and a professional that can help elevate cybersecurity. We really need people who can do that. I know you guys are getting great technical skills, and we really need that too. But to make sure that we're, true leaders and staying on top of this is going to help national security, no matter where you live. It's going to help, protect our critical infrastructure, help to protect our businesses, our economies, and us as individuals. So the work that you do today and that you're going to do in your future is really important to all of us. So thank you. So cool kids are trilingual professionals who can fluently speak tech, cyber, and policy. Remember that.
So fluid in technology, cybersecurity, and policy. We have time for one question, please, from a student in the seminar who was rustling papers during the, I'm sorry, go ahead. One question. Come on. One question.
Should crypto be considered an asset or a currency?
Very good question. Terrible debate to have, right? Because it's such a huge debate. I don't think it's ready to be a currency, so I would keep it as a security for now.
You say that it's more used as a currency than as a security? It's actually traded as a currency?
Well, For now, because, until cryptocurrency can be a stable value, like when it gets pegged to the dollar, it's really challenging to say it's ready to be a currency. Because we've seen currency fluctuations take down economies, places like Venezuela and whatnot. So we want to be cautious about moving in that direction until we're really ready. That's what I would say. But I'd love to see us get there because cryptocurrency could be used to help people all over the globe, right? And put, help the people who can't get access to banking get access to it. And that's one of the big promises.
So Lisa will stay around for another 5 minutes. Thank you all for coming. Thank you all for staying a bit over. And I look forward to your reports this week.
Thanks, guys.